thank you guys for taking the time to spend whether you're in the United States, your morning, or if you're abroad, maybe your afternoon or evening with us. Later today, you're going to be hearing from Mr. Neal Lee. He's our Vice President of Finance on this specific deal. But I, again, wanted to take a little bit of time just to say hello, welcome you, and explain a little bit about why NHK was created. This is actually our third offering. We have successfully closed our first two. And NHK was really born from the success of an affiliated company that we have, which many of you on the call are investors in, prospects looking into EB5, or even individuals in the industry. And so based upon our success in the EB5 space, a lot of our CMB investors, after getting their green card and a return of capital, have asked us and said, do you have a more traditional investment vehicle that we could continue to invest with you? Additionally, the Hogan family has, just like our investors have seen success in, EB5, and then also, we have another affiliated company, Rock Island Auction. We have made investments as a family. And so it seemed, very natural to create this new platform, NHK Capital Partners, whereby we would allow our investors and clients to be able to participate alongside the Hogan family in investment opportunities. So NHK truly really was created based upon the foundation and the success of our CMB clients and the success of our family. In any of our NHK partnerships, the Hogan family not only participates at the GP level, but we also participate at the LP level. We back 100% of the investments of each offering. So if, for example, for some reason, we didn't fill an offering, the Hogan family would actually be investing 100% of the raise amount that we're actually going out for, because these are investments that our family want to invest into. In this particular investment, we've already committed to no less than 20% of the funding that we're going out to actually raise. And in this deal and going forward, we're always somewhere between 10 to 20% of the capital stack in a project, because as a family, we see these as opportunities that we want to be a part of. And so it's unique because we see these as opportunities that our family would otherwise do, but we're actually providing to our investors and to our clients to be able to grow their financial success alongside us. We're really excited to continue to offer you very good quality investment opportunities. And we look forward to working with you, as we have a lot of you in the EB5 space, but now in more of the private equity investment space. So again, thank you for taking the time to spend your morning or afternoon with us. Neal will be providing you more detail on the specific project, as well as the team with individuals such as Matthew Temple. So we look forward to having additional participants in our NHK platform, and we welcome you to our family. Thank you.
Hello, everyone. This is Neal Lee. I am the Vice President of Finance at NHK Capital Partners, as well as CMB Regional Centers. I also have Matthew Temple with me today. Matthew is my senior analyst, and he's been crucial in underwriting this deal, but also I'm going to leverage him today to maybe tease out a few FAQs for your benefit. I also have our case managers on standby, as well as Kenny Pang on this webinar. So for those of you who are not English speakers, feel free to ask any questions on the chat box or the Q&A box, and we'll try to address them in real time after my presentation in your language. So again, this is going to be me talking through this opportunity, and then we'll have a quick Q&A session at the end. So without much further ado, let me begin. So before I go into the actual explanation of what our investment is going to entail, I wanted to start with our investment thesis first. As this is a real estate investment, location, we'll also talk a little about the DFW area and the location of this investment. So first, what is an SFR or single family rental and why? I think is pretty pertinent to our conversation today. SFR or single family rental is a rather new concept that's gaining a lot of attraction post-COVID world. And what it is it's a rental property that is built on a horizontal scale. So imagine your single family homes here in the US, but they're built specifically for the purpose of renting. Typically, the rental market here in the US are more skewed toward multifamily units, apartment units that are stacked on top of each other. But through the 2020, the COVID era, I think a lot of people, have had some change in their lifestyles. They wanted to pan out a little more, seek some additional space, and that's been the genesis of this new look into the SFR space. Furthermore, there's a long-term demographic trend that is also in play here. If we look at the data, the census data, what we call the millennials, so the mid-20s, the early 30s, up to their early 40s, tend to purchase their homes later in their lives than their previous generations. And so, for example, a study done by Berkshire Hathaway Company shows that there's a longer term lease by these millennials. And they account for about a 20% premium for rental units, and especially after this COVID era, for units that have a private entrance, some space to work with, and so forth. Now, as I mentioned, the rental market has been, in the US at least, been skewed toward the multifamily units. And this is a list, a view of the total housing stock in the US. And if you see, here, let me get a pointer option. There we go. If you look at the overall stock, it depending on the statistics, it's about 120 million to 130 million units of housing stock in the US. And of that, about 2/3 is owner occupied, and 1/3 is about a renter occupied. However, if you look at the specifics of it, the single family is more skewed toward ownership. So 2/3 of single family homes are owner occupied, and 1/3 of them is renter occupied. And as I mentioned, multifamily is the direct opposite of that, whereby traditionally multifamily was built and catered toward the rental market. So what this means is that with this aforementioned shift in the preference of people, wanting to maybe pan out and enjoy a little more space, there's a lot of room for renters to grow into in the single family rental or single family units market. And this also shows this next slide, it shows the dissection between the attached and the detached within the single family market. So a detached unit, again, is your typical single family homes that does not share any wall with any of your neighbors. An attached unit is a unit that has a wall that is shared with your neighbor. Think of a duplex or a triplex that has a common wall in between. And those two has been tracking pretty close to each other for the past 15, 20 years. However, you see the bifurcation as of 2020, whereby the interest for the detached units are significantly higher than the attached units. So meaning, again, additional support for this thesis that the single family rental demand is on the growth. This is all culminating into additional interest from the large investors from Wall Street. So on this page, you see a list of these investment firms, and this is just since 2020 that have invested into the SFR space. And Invesco, for example, committed and is in the process of investing $5 billion into purchasing about 20,000 SFRs across the country. Lennar and Centerbridge, also a large private equity firms based in New York, another $4 billion. And the list goes on with the latest edition of Blackstone, the world's largest private equity firm, acquiring Home Partners of America for $6 billion. And they now are a proud owner of 17,000 plus single family homes for rental purposes across the country. Now, these billions of dollars that have gone into this space recently still account for only about 2% of the overall stock, the 130 million housing stock that you saw. And so what this also means is that in the single family rental market, there is a large space for these investments to grow into. So this again ties into our investment thesis, whereby our single family rental, the Storybook single family rental property that we're going to see today, is going to add about 240 units of single family rental stock. And what that's going to create at the end of the investment term, or toward the end of the investment term, is that one of these institutional investors are going to be interested in acquiring as part of their SFR portfolio. And and I'll be talking a little more about this later on, but NHK has had to go through a bit of a competitive process in order to secure this deal with our partner, Stillwater Capital Partners, because excuse me, because of these large interests from these New York firms and investment firms in this space. Now, as I previewed, okay, the investment thesis, I understand, is that it's a single family rental property, and we've just seen a few data that supports why the SFR may be the next bright spot in commercial real estate. But also, it's a matter of, okay, where is this going to be located, since we are talking about real estate. And this Storybook investment is going to be located in McKinney, Texas. So McKinney is a northern suburb of Dallas. And I hope you see my red laser pointer. So this is currently it's a fun ranch. So it's 25 acres of land, that used to be that used to attract children and families for a pony ride, a maze made out of haystacks, that kind of stuff. And Stillwater Capital and NHK are partnering up to redevelop this fun ranch into the SFR space. And so from Storybook to Dallas is about 30 miles, and it's a commutable distance. We actually have two of our employees at CMB here in the Dallas office who are commuting from McKinney. So and McKinney being one of them. And the typical one-way commute would be about a 40-minute drive from Storybook to Dallas and vice versa. McKinney is also a very approachable neighborhood from DFW Airport here. You have the Rayburn Tollway, or the 121, Texas 121, which again is about 30 miles away, from the airport. And I want to say it's about 30 to 40 minutes of drive time from McKinney to DFW. So it's a northern neighborhood with good schools, and we'll see some additional statistics about McKinney, with good access to not only the employment market in Dallas, but to other infrastructure within the greater DFW area. Just a few additional statistics. McKinney was ranked as the 4th fastest growing city in the US by the Census Bureau. And the McKinney submarket is ranked as number 2 as the best residential growth pocket in North Texas. So if you go there, it's a very nice neighborhood. I mean, that's how I could probably sum it up. The SFR vacancy of 3.8%. So there aren't many SFR properties to begin with, but they are all fully leased, and there is a strong, again, preference and growing preference for the SFR properties. School is another very important aspect. McKinney in itself also has a good school. Frisco, which is the neighbor to the west, has also good schools. And because Storybook is closer to Frisco than McKinney proper, it's located and included in the Frisco Independent School District. And both of them, again, excellent school districts. They're ranked number 7 in Texas. Now, as I mentioned, a few additional statistics to kind of give you an idea of what McKinney is about. This is a view of the incomes, household income levels at each income bracket between McKinney in blue, DFW in general in black, and green for Texas. And as you can see, what this represents is the income bracket of 100,000 to 150,000. McKinney far exceeds the overall DFW metro or Texas in general. So again, $100,000 to $150,000 income bracket. McKinney shows about a 21%. As compared to 15% for the DFW general and 14% for Texas. And translated that into an actual annual income, median annual income numbers. McKinney in 2019 showed just a hair below $90,000 per household, as compared to $64,000 for Texas for the same period. And for those of us who are not as familiar with the DFW metro area, DFW is the fourth largest MSA in the US. Currently, we have about 7.5 million residents and growing. Since 2010, it's grown about 15%, or translated into an annual growth rate, we're ranking anywhere between 2 to 3% annually. Just in 2020, this might be quite interesting. We've had 16,000 households move from California, and this is a 20%, close to 20% year over year increase from 2019. Another 4,500 households from New York, and to a lesser extent, albeit another chunk of households moved from Chicago. So, we see in the news every day here in DFW how a new company moved down, and how the employees with that company also are planning to move down. And again, since the last 5 years or so, Toyota is headquartered in Frisco. As you saw in the previous map, Frisco is another northern suburb of Dallas. Oracle, the IT company, recently relocated to DFW. CBRE, which is the world's largest commercial real estate consultancy, appraiser firm, also moved down here. Samsung is expanding their presence here. Visa, Charles Schwab, your investment firm, JP Morgan Chase has a large campus here, JCPenney as well, and Tesla. I think everybody would have read about Tesla moving down to Texas, not necessarily DFW, but Texas in general. There's over 200 active relocation or expansion projects in the pipeline for DFW as of today. This is all culminating into an over demand situation for housing in the DFW area, and that this has been going on for the last at least 5 years. And this is a chart showing the excess housing stock. So minus excess housing stock obviously means it's an over demand situation. So in 2020 or third quarter 2020. It was reported that there's about a 22,600 unit deficiency or undersupply or over demand situation. However, surprisingly, with that sort of over demand, the DFW rent affordability has been keeping it stable. And in the last even 10, 15 years, we've seen a steady increase of about, call it 2 to 3% annual increase. But it's, compared to the overall US market rent per unit, which has been going up at a far higher pace, as shown here in the yellow line, the DFW area rent has been, keeping it stable. And this is due to, stable demand, but also stable supply so far, albeit the undersupply situation that we've been experiencing. And the more interesting thing is that the age bracket of 20 to 35 years is the age bracket that are, that have the highest renters, and at 56% of that group. And guess what? The DFW population growth is driven by those in their 20 to 30s, meaning, these are professionals that are freer to move to a new area with their employer, And so we're seeing a large influx of the younger, professional generation moving into the area, which again, further adds to the bottom line of the stability of the rental demand, I would say. So with those two thoughts in mind, the investment thesis surrounding the SFR product, and also a quick view of what DFW and as well as the McKinney market shows. What is our investment? What is Storybook SFR? Well, it's as I mentioned, the Storybook Ranch, as it's called today, is a 25-acre lot, and it's already been pretty much built out surrounding. To the north of the lot, there's a retail facility, banks, your yoga studio, your vet office, and to the south of it, you have residential area. And so it's almost like an infill development. Again, all the infrastructure is already in place. Stillwater and NHK are contemplating and have gotten the entitlements to build up to 241 units. And the current unit mix that we're thinking about is 1 bedroom, 1 bath, 108 units, another 108 unit of 2 bedroom and 2 bath units, and a smaller group of 3 bedroom and 2 bath units. The average monthly rent is something that I might want you to remember. Is at about $2,300 per unit, or translated into per square foot, it's about $2.1 per square foot. Now, I'm going to be showing you a comparison that is just about 7 miles south of this area, and that is currently operating and actually, fully leased out. And they're renting currently today at, call it $2 to $2.3 per square foot, depending on the unit that you're trying to rent. Amenities, you have so this is also a differentiating factor from other, call it SFR investments. This is a centralized development with your central management office, leasing office, but also for the tenants, it's got a fitness facility. It's got a clubhouse essentially with a fitness facility, a resort style pool, outdoor kitchen, multiple green space areas. So it's going to be a very nicely appointed experience living here. And that's going to be a differentiating factor from, say, the single family rental concepts that we've just talked about, that the Wall Street guys are investing into, which is just, grabbing and picking existing housing units and converting them into rentals, right? So again, if you live here, you get the service of a centrally managed office, but also you get a pool, you get a fitness facility that is all included in your rent. Whereas if you're renting from Blackstone, then it's just another house on the block. That makes sense. These are some earlier versions of the renderings currently, and I'll talk about it when we talk about timelines. But as I mentioned, all the entitlements are in place. We are going through the construction drawing phase, and also bidding out and getting the construction budget firmed up with a target date of getting a contractor in place and ready to break ground by October, November timeframe. So this is a view of a 1-bedroom unit. This specifically is an 850 square foot unit, and the rent, asking rent would be about $2,000 per month. This is a smaller one-bedroom unit at just a slightly less than 700 square foot. Asking rents would be below 1,700 per square foot. This is a two-bedroom unit concept. Again, as you can see, there's greenery, there's detached unit, obviously. And as you go into the two-bedroom and three-bedroom units, you also see that it has attached garages, which is going to be another selling factor. A view of what the clubhouse will look like. Again, early renderings, and this is going to get further detailed as we go. And we now get to the comparison that I mentioned. This is another McKinney, Texas single-family rental, actually one of the few that are in existence. It was completed actually last year, and it's fully leased out. It's about 7 miles away from our site. It's a smaller development. It's only got roughly about 100 units there. And as I mentioned, for the 960 square foot unit or two bath unit, it's renting at for 12 months 2.3 per square foot, or $3.7 per square foot if you're wanting to rent it for 6 months. And these are actual data. Matthew actually called these guys up and asked around as if you were a renter. That's how we got these data. And if you go to the larger unit, obviously the per square foot price would fall a little bit, but the per unit rental is still at $2,500 per square foot, or sorry, per unit. Moving on to back to our Storybook investment and looking at the financial structure before we go into what the offering will look like. So overall, this is going to be a $68 million budgeted new construction for a single family rental property. Of that, about 63% of that, or $43 million, is going to be secured by a senior loan, a mezzanine loan of $13 million, and we're going to have about $12 million in equity split between NHK and the sponsor. So NHK, it would amount to about 6.7. Just I'm rounding these numbers, and sponsor equity would be about 5.5. The breakdown, and I won't go into detail, but mostly it's going to be the hard cost and the land cost together is going to account for about 55 million of that 68. The rest is going to be soft costs, financing costs, etc., and contingency of course. Now, what does our offering structure look like? Well, this is going to be a straight up joint venture between NHK and Stillwater, the sponsor or the manager. Now, for those of us, and I've noticed a lot of our participants today had joined us in our second NHK investment, the JW Marriott. You might recall, for those of you who were present for that investment, you might recall that one was structured into an equity loan structure, whereby there was a layer of a loan. However, in this investment, again, I stress that is a straight up joint venture. It's a partnership between NHK and Stillwater Capital. No equity loan layer. The current owners of the land, or the sellers, I should say, looked at this new investment, this SFR concept, and they want to contribute, approximately half of the proceed from the land sale, up to $4 million into this investment. So they're going to go into the developer entity. So as I mentioned, the developer entity, again, round numbers, in that $5.4 million of developer entity equity investment, about $4 million is going to be from the sellers of the land. I think that just shows how, I guess, competitive this concept and this thesis is to many of the stakeholders. Stillwater Capital, again, will be the manager, and we'll have a separate development agreement signed with Stillwater Capital. They'll be running to the day-to-day. There will be the developer managing the actual development. Under the JV agreement, NHK will have the right to intervene and also make decisions on major decisions. Major decisions like, selling the asset and so forth. Between NHK and Stillwater, we have a tiered hurdle structure or a promote structure. And what this means is that, NHK as the money partner, if you will, we're getting for the first 10% preferred return. So what I think I ought to explain this a little better, but what does preferred return mean? Well, as you can imagine, this is a new build. So the construction period is going to be about 24 months, the first 24 months, let's call it. And then there's going to be a ramp up period whereby now you have a completed SFR property. Now you have a management firm, and now you're going to have to go out and get renters, get tenants. So during that time, there won't be any cash flow or any distribution. However, under this 10% preferred return structure, what we don't get at that year gets compounded, gets accrued, and when there is money that is distributable, we will go back and claim that. And so every year, up to the first 10% preferred return, NHK will sweep 100% of the cash flow. And up to the next hurdle, which is 16% of preferred return. Again, the same concept. If they don't meet this 16% in any given year, then it just gets accrued and compounded and payable when there is money available. NHK sweeps 75%, Stillwater sweeps, or the manager sweeps 25%. And once we meet all this, then at the back end, between the manager, Stillwater Capital, and NHK, we share 50-50. And this is a typical promote structure, which is intended to incentivize and motivate the manager, the day-to-day operator, and the slash developer to overachieve. And because overachieving will mean that they also get a economic interest, outsized economic interest, but we also get to tag along. For the NHK Storybook LP, that's our partnership entity that you as potential limited partners are going to be investing into. NHK is offering a target investment term of about 4 years. Again, this is based on the business model. and I will speak further to that in the coming slides. But again, the first 2 years is construction phase. And then the next 2 years is operations stabilization / sale phase. And once there's a liquidation of the property, that's when our investment will reap its returns, and the investment partnership wound down. Currently, the target closing date is set at about in October of 2021. So we probably have a month and a half or so for the fundraise. I do have to tell you, I think, and Matthew, I'll let Matthew speak at the end during FAQ, but it seems like there's a lot of interest, at least verbally for now, because the offering documents are still being formulated as we speak. That accounts for much of the $6.5 million, $6.6 million investment that we're seeking. There is a one-time subscription fee of 5%. Again, for those of you who have joined us in the past investments, again, the same structure there. Minimum investment also same, $100,000. We have not upped it. Now, there is a difference in the annual fee that we'll be charging from, say, the last investment in JW. Because this is a straight up equity investment, and we are cognizant of the fact that for the first 2 years that there won't be any cash flow, NHK is not going to charge any annual fee for the first 2 years. The annual fee of 2% will only kick in on the 3rd year when money starts flowing. So that, I think, is a structure that might be further beneficial for the LPs, in the sense that you don't need to pay that out of pocket. It's only when money starts flowing that we will start charging. We as an NHK will start charging the annual fee. Now, going back to our the project and the per square foot assumption of $2.1 per square foot, and I ask that you remember that number. That's the basis of all of our returns, right? Our projected returns. Now, that $2.1 per square foot is a conservative look. The market study that we've done on this property, on this concept, the folks came back and said their recommendation is that we charge in today dollars, $2.23 per square foot on our rent. However, we again, NHK is all about being conservative, as was CMB on any count, on the job count, for those of you who remember, and also on these financial projections. Once we reach that $2.1 per square foot, which again is a conservative number as compared to the recommendation from the market analysts, then we're expecting our limited partners to achieve a target equity multiple of 1.74x. This means that if, with a $100,000 investment, then, we're targeting $174,000 return. Target IRR at 21%, and, over that 4-year term. However, as I mentioned, the first 2 years is construction timeline, and then the next 2 years is operation. So depending on, how that operation, that ramp up goes, I think there's going to be a real opportunity for an earlier exit. And if an earlier exit, it just means that it's a higher IRR than our target. Now, again, the cash flow from operation will be non-existent for the first 2 years, as you can imagine. It will be minimal for the next 2 years because, from operations, it's all about, servicing the debts, and the largest return, the lion's share of our return is going to be skewed toward the end when the liquidation of the property is going to happen. This is a view of how that the cash flow will work. Again, this is pretty generic, and I think if you have genuine interest in reach out to us we've done this in the past where we can simulate, for whatever investment amount that you're seeking, we can simulate one of these, cater to you. But again, just bottom line, the investor contribution on the first year, and then again, the first 2 years, there isn't going to be any cash flow. The third year, this $1 million, it's representative of cash flow from operations. And then the lion's share of the return is going to be skewed toward the end on the fourth year. And again, for here, you have 7.2 as a placeholder. And the reason why this number is bigger than the net investment amount into the property is because it's accounting for the fees, the 5% fee, and also some residual that will stay at the partnership level to cover, miscellaneous costs. So what that means is when we talk about the 1.74x equity multiple or the IRR returns, this is based on your money out of pocket. So, including your 5% fee. I briefly mentioned this. Again, it's the investment timeline. The breaking ground, we're still expecting October timeframe, October, November, if things slide a little bit, but the Q4 ground break, and approximately 21-month construction timeline. And that will get us to, end of third quarter, early fourth quarter, 2023. There is a lease up period, meaning this is the ramp up period where, now you're getting the word of mouth out, you're talking, you're doing your marketing drives, radio ads, Facebook ads, you name it. And by the second quarter of 2024, we're expecting the lease up to be completed. And then an additional, year and a half of operations. And this is the window, depending on how the ramp up goes, whereby we can, comfortably exit from, during this period. But again, for our business plan purpose, the target exit of investment is pegged at Q4 of 2025. So overall, it's a full year schedule from beginning to end. This is quite interesting, whereby, this is what Stillwater Capital Partners here in Dallas, Texas, have been able to achieve. Stillwater and CMB go way back. Actually, it's our first project together was a CMB Group 25. And we're at group 80. So you can imagine how far back we go. But, Stillwater has grown, alongside us, I would say. And, we've done multiple deals together, and likely they've achieved great things. They've delivered on their promises so far. And, from their corporate portfolio, they have $8 billion in real estate transactions to date. They've grown to about 70-member team, and they have offices not just in Dallas anymore. They have Frisco office, Austin, and they're branching out to other states. These are some of the projects that they've been able to achieve. The Crosby IC, that's our CMB Group 65 investment. This is our Group 25 investment, I can see. The most interesting thing about Stillwater and CMB's collaboration is that now, because of the sheer benefit of having that relationship that spans multiple years, and having gone through full cycles of these investments, Stillwater was able to actually construct ground up and sell on average about 3.3 years from breaking ground to the exit. Or said differently, because these are typically 2-year construction timeframes, 2 plus another 1.5 years until exit. And so that jives in with our current business plan for Storybook. This is what they do. They build a great asset, and they lease up in record time, and they find a buyer who's going to pay top dollars for that. And Stillwater Capital has been able to sell each development on average about 8.6% above the originally underwritten target sales. And the reason for that is because, as you saw, we're using conservative numbers, and therefore, when it comes time to actually deliver and sell these assets, you're overperforming, under promising and overperforming. That's our motto. That's the end of my presentation. I noticed there's questions. And so I'll stop sharing here, and then I'll invite Matthew. Hey, Matthew, are you there?
Yeah, I'm here.
And then we can maybe go on to some of the prepared FAQs. I know you've been talking already to a lot of our investor groups. So I wanted to capitalize on that and maybe leverage what you hear, what are the more commonly questions that have come up, and then maybe address that. And then, as I promised, those questions that were listed on our chat or Q&A box, as much as we can, we should address.
Yeah, great. If people can address their questions to the Q&A, not the chat, we can mark these off and dismiss them so we know that they're answered and they're taken care of. So if you can just address that, and any questions could go there, it'd be perfect. Some of the early questions that we've been asked about this investment is, what are the options for investments? What are the paths as an individual, as a company? So I can answer that because we've now done our second offering. Really, it's individuals can invest. They just have to be an accredited investor or outside of the U.S. In addition to that, we've seen investors who've funded through retirement accounts, their LLC, their trust accounts. We have investors who maybe has a brother or a father or a relative who wants to invest side by side. Maybe they don't have quite the $100,000 minimum, and they invest $50,000 each. Both are accredited, so they came as a partnership. So there's multiple ways to invest. If you reach out, we could just pass it through our brokerage firm and confirm that it's possible. In addition to that, how much can I invest? The minimum investment is $100,000. It is in increments of 50. So minimum 100, you can go up to 150, 250, 350. In the past offering, I think on average, it was about a $300,000 investment per investor. So whatever suits you.
Right.
Yep. Another common question that we get is, can I cash out and sell my interest share prior to the closing of the investment? So again, this is something that make sure all investors are known that, once they invest, they're invested. There's an LPA agreement which clearly states that their entire investment is illiquid and it will be wrapped up the entire term of this investment.
Great.
That's the answer to that.
And I know, in the past, we've had inquiries about potential EB5 investors, and especially now that the EB5 program, at least the regional center program, is currently lapsed. Is there a special consideration for those of us who want to maybe use this as a landing platform for future EB5?
Yeah, so we've contemplated this with Noreen and the Hogans. Each case would be kind of discussed internally and at the sole discretion of the GP for NHK. If the case is, optioned, there is a possibility that we at NHK could purchase out the interest of an LP if they are planning on moving to the CMB platform. But as I said, that's it's not guaranteed. It is definitely a case-by-case decision by the GP.
Okay. What are some other questions, maybe?
Yeah. So another big question. It's very loaded. What are the risks? Obviously, this is a JV agreement. If you can explain maybe the upside, the downside to this agreement, the potential risks that they might face.
Wow, that is loaded. Sure. I mean, we've all lived through COVID, and I can speak, for myself and my family, my extended family to that extent. My cousin had a wedding planned in May of 2020, and it was an impossibility because no one was traveling, and life was put on hold, and everybody had to shelter in place and work from home. We all experienced that. What that means in a macro level is that industries like travel industry, like hotels, hospitality, they've suffered a great deal last year, and we've seen that here at CMB as well. However, if there were any shining bright light area of the economy last year, it would have been the residential market. I mean, we've seen an increase in housing prices overall, but this SFR is truly, probably the phenomenon that came out of that experience. That in the U.S., a third of the population are renters, and that's just a very rough number, but that's still pretty accurate. And the renters, especially those of us who were in the bigger cities, experienced the horror of living on top of each other, I would say. And so it really drove this phenomenon where people wanted to span out to have more space, and especially with their employers allowing work from home or remote work environment, it made it possible. And so again, I can't stress enough the shift in trend from especially the smart monies, the big monies of looking, how they look at this SFR, the housing market, and SFR in specific. So I would say that's the upside. We're right at the cusp of the beginning of that kind of big trend, I would say. And as I mentioned in my presentation, this is a centrally managed newly built SFR oriented property, very different from just these other investors who are, racking up existing homes, maybe doing a little, renovation work, and then flipping it to renters, right? You have your central amenity, you have your pool area, your management office. That's all a boom. So coming back to the question, I think the upside here is that, whereas we're looking at this and targeting and projecting in a linear fashion, if there is, enough interest and continued interest from these Wall Street firms, then the exit price is, there's a big upside. It would be my crystal ball, if you will. The downside is that, and we've experienced this the last 3 months now. As Matthew, you might recall, we started talking about this deal last year, and we're already in August of 2021, and the supply chain disruption coming from COVID has all sorts of ripple effects, but it does definitely have a ripple effect in the construction business. So we've had quite a rough ride in securing and tying down these budgets and these subcontractors, and subjecting them to a price, because of the supply chain disruption. The subcontractors we found that were pretty shy, from giving a definitive price for their works. So, but I think we're beyond that now. And the other, I guess, factor that's very beneficial, for Stillwater Capital is that they've a few years back launched their own general contractor affiliate. And so they have their GC in-house, meaning, and also they've been, in business in the Dallas area, in the DFW area, the last 30 years. And so they have, well-established networks with these, subcontractors. And so I would say that risk has been, mostly mitigated now. And the $68 million budget that we presented today is the culmination of that kind of turbulent, phase, if I will. Now, the mitigation side. So as you asked, what are the upside, what are the risks? Again, our projection itself is pretty conservative, as I mentioned a few times already. We're at $2.1 per square foot. The immediate market study came out and was suggesting 2.23, but again, that's good, that's awesome, and it'll probably go up from here. But with the over demand situation that's prevalent in the DFW area. But with that $2.1 per square foot projection target, we're getting to that target return that we just talked about. So the last thing that I would talk about is the hurdle structure, right? So as I mentioned, the hurdle structure, as the money partner in this case, NHK wants to secure a level of return prior to the sponsor, but we also want to motivate and incentivize the sponsor to do better, to excel and reach for the stars. And we do that by incentivizing the back end, and that's where we're 50-50. Anything beyond the 16% accrued and compounded preferred return. And so with that, I think we can definitely achieve a good result for our investment.
Okay. Thanks for the explanation there. I see there's a lot of questions coming in the live chat. I just have one more question that's typically common before we get into the live questions. What's the role of the GP and the interest in the partnership? Is there a fee structure? What is that like? I know you briefly covered that.
Sure. So this investment is it's a partnership, right? So it's NHK partnership whereby NHK is acting as the general partner, and our investors today participating are potential limited partners to that partnership. So as a general partner, the limited partner and the GP will be signing our limited partnership agreements. And for those of you who have gone through, previous NHK investments, even CMB investments, it's a very similar structure, whereby the GP is tasked with doing the day-to-day operations, if there are anything that has not gone as planned, the GP will pursue remedies. The GP will, use its resources to troubleshoot if there is any need for that in the future. What this all means is that, and this is what we aspire to achieve, right? Our limited partners, right? They have their own livelihoods, and they're looking at us to structure and bring forth a good investment, but also something that is that they can invest passively, right? So we're the one who's running the day-to-day, who's been working the last 8 months to structure this deal to the best extent possible, and balancing the risk and the reward, right? And the GP is there to manage that so that the LPs can enjoy a passive investment and reap the investment benefit at the end. The fee structure I mentioned earlier. There's an upfront 5% subscription fee. Again, that's been the case since our first NHK investment. The 2% annual management fee, we're gonna only start collecting that on the third year when the money starts flowing. And this is a nod to the shared JV structure that we have here, whereby the first 2 years during construction, there aren't going to be any cash flow. So we don't want to, create a negative capital account balance necessarily, with our 2% fee.
Yep. I think we can roll into one of these live questions. It kind of relates to the GP and question. It's, can I use a self-directed IRA to invest? I don't know if you want to go into that, but I do know that self-directed IRAs, they do have very stringent requirements where you cannot participate. You have to show there's a arm's distance length away. So this may be an opportunity. The fact that the GP is managing day-to-day operations and you are a passive investor, but I think if we can look into that and discuss with Prevail and see if this is an option.
Yeah, I would ditto that. That's a perfectly good question, and it might be an opportunity in the future. We have not done I guess a deep study into, and the reason for that is that would require additional I think I guess disclosure, I guess control from the regulatory offices. And we so far have not gone through that. So for now, the answer is a no, but we'll definitely revisit.
Yeah. One of the first questions was, will any capital calls happen during this investment period?
Good question. Can't say no. Again, a capital call is a function of any investment vehicle. And so you'll see that in the LPA, there are languages about capital calls. What I can also tell you is that in the JV agreement between Stillwater and NHK, there are other ways of raising funds that don't necessarily have to culminate to a capital call. So in other words, we can put in member loans in place of capital calls. Obviously, if the requirement for the capital is becomes greater than what can be covered through a member loan, then then I can't say we'll never do a capital call. But there are other measures to not, I guess, culminate to a capital call. But more importantly, and this is where I wanted to emphasize the I guess the turbulent ride that we had in securing this budget, right? Again, you probably saw in the news how a lot of these supply chains have been disrupted. The auto industry is another good example. You're hearing every day that the chip shortfall is affecting and have created, at least in the US, a very bullish used car market. The used cars, it's at its highest in the last 20 years or so. So it's a real thing. However, as I mentioned, our budget as it sits today, the $68 million, is close to its final. And additionally, we enter into what we call a GMP, or gross max price contract. And under that construction contract, you have a set number of dollars for your hard construction. And now the contractor has an obligation to build at that construction price. Again, there can be change orders and things of that nature that may again require a capital call, but we're not expecting necessarily at this point that there will be a drastic increase in budget, because we're securing and firming up a lot of that beforehand. Hope that makes sense.
Thank you. To go into the construction again, where are we on the permit process? Have all the permits for SFR been obtained?
Sure. So as I mentioned, the zoning has been approved, meaning the entitlement is there. Now, typically the construction permit occurs, days prior to the actual construction. So, and that is why currently we're working on the construction drawings, and those are all requirements for the construction permit. So we don't expect any delays or snafus necessarily from, say, entitlements, because that's always the big hurdle. That the entitlement phase is where you have neighborhood hearings, you meet with the city councils and the zoning board and so forth and so on. So that's all been done, and that took and we've been walking through that entire phase along with Stillwater. Now, going forward, it's again getting the requirements for the actual construction permits, but with an entitlement in place, the permit is more of an I would say an administrative process than a political process, if you will. Okay.
Regarding the kind of expected cash flows, what kind of income will be recognized? Ordinary income in the year 1 through 3, capital gain in the year when the asset's sold. I don't know if you want to pull up the projected cash flow again.
Which question are we on? Sorry.
We're on question, the live question. It's the top one. By when it's what kind of income will be recognized? Ordinary, bringing the operational and capital gain when the asset is sold.
Sure. So again, it goes back to the main structure of this investment. This is a JV structure. So again, if you were part of the last investment, NHK investment into JW Marriott, That one had an ordinary income portion because we had an interest, distribution. In this case, the only ordinary income that would come from this would be any distribution from the operations of the SFR. The return from the sale of the asset, which is, again, I would say, 95% of our return, is all going to be considered capital gain to the partners. So again, I couldn't quantify necessarily because I don't know what your investment amount is going to be when, or but just conceptually, the distribution from the operations is going to be considered ordinary, and the distributions from the sale of the asset, which again accounts for 95% of our return, currently is going to be considered capital gain.
Thank you for that clarification. The next question, what is the estimated asset value at the end of year 4? So at, I would say, liquidation event. I can go ahead and answer this. With recent targets, the approximate value is going to be $84 million. As Neal mentioned earlier, the target and budget is approximately $68 million. And to even roll into the next question that's further down on the exit strategy, what is the cap rate assumed in the investor's projected cash flow? Right now, the cap rate that's used is a 5.75% cap rate. What's interesting about SFRs is you're seeing the cap rate actually shrink with the actually pricing per square foot increase. So usually you would see maybe one fluctuate the other way and the other one the other way, which helps stabilize that trend. But in this situation, with this asset type, you're seeing not only an appreciation with the cap rate shrinking, but also with the pricing per square foot increasing, so boosting NOI. SFR being a good hedge for inflation, you can mark to market since it's only yearly leases. So everything's trending in the right direction for this asset class.
And this is, again, this is just for I guess an FYI. It doesn't pertain to our investment, but I'm just mentioning this because it came up recently in a separate conversation, in a separate SFR related investment deal. And in that investment proposal, the investors were contemplating a 4% cap rate on SFR properties. And this SFR, different from ours, wasn't a centrally managed new build. It was one of those pick up older houses, renovate, and flip it to rental. But even in that scheme, they were looking at a 4% cap rate. So I would say the 5.75 that we're using here, it's got room to grow, I would say.
I agree too. Next question we have is, the market is very hot on both rental and selling. The project will start to rent in Q4 2024, question mark. What if at that point the rental market is not hot anymore? Can you assure profit?
Well, Vu, that's to the crux of this, this investment, right? So that's the decision that you will have to make, right? Again, what I can do is I can provide you, and that, I hope that was what I achieved, through my presentation today, the underlying, fact sets, the data to date, looking at current trends that are leading up to today. But, what will happen in the future is always, speculative. I mean, unless you come from the future, obviously. Just to, as a quick recap, what we saw was the SFR theme in itself is where a lot of the smart monies, the Wall Street monies are, are flocking into. It's not a one-off fluke event. It's based on many trends. The one trend following COVID is kind of the shift in preference from the renters, but also there's also the underlying trend more demographically, right? Again, I regurgitate, but the younger generation, the millennials so-called, are renting longer, and so they're going to stay in the rental pool longer. The baby boomers, on the other hand, are aging, and so now they're selling off their houses, and because they don't want to mow lawns anymore. They've been mowing lawns the last 30 years. They don't want to do that anymore. So they're looking at facilities that are that take care of all that for them, and they don't need that much space anymore because they're typically going to be empty nesters. So and the baby boomer and the millennial, if you look at the overall demo, they account for a very large portion of the overall population. So there's definitely a macro trend going on here. And additionally, we talked about the location, right? We talked about where the DFW being at the receiving end of a lot of these moves from out from the bi-coastal areas, namely New York and California, into states like Texas, where you don't have income tax. It's business friendly. You got a lot more space than living in Manhattan, for example, and you can buy a lot more, or you can rent/buy a lot more house than you could in New York. And add to that, your employer, the company you're working for the last 5 years is also moving. So you don't have a disruption and the stress of having to find a new job necessarily if you happen to work for CBRE and now they relocated to Dallas. So these are all underlying facts, and the reason why our investment today is focused in SFR in McKinney. The decision as to how can I assure the profit, that's your decision, I would say. I hope that's fair.
Okay. Thank you. The net return of 74.45% is before or after the subscription fee of 5%. So essentially, the projection shown on the cash flow page, are those baked in with the fees?
So for simplicity's sake, when we talk about forward-looking statements like target returns, like target IRRs, we try to make it as simple and as intuitive as possible, meaning it's your dollar out of your pocket, including your subscription fee. So if you invested $100,000 with us, and $5,000 of it went into the subscription fee, and $95,000 went into the actual investment, and you got back $175,000, then you got $175,000 back for your $100,000.
Okay. So in simple terms, the fees that they are structured within the return. Thank you.
Yep.
What happens if the JV cannot exit after 4-year target date?
Very good question. Always a possibility, right? And there may be a case where a cannot situation, but also should not situation, right? If for example, if the rental market is bullish as ever, you're making a good profit just operating it, and I'm just making scenarios up, but the cap rate is somewhat compressed, and you think you'll get a better cap rate the following year, then you might want to hold on to your asset, right? It just makes common business sense. So what happens if you cannot or should not exit on the 4th year? then the LPA and also the JV agreement with Stillwater just goes on. So we will collect the distribution from operations until the exit happens. So there's nothing that really mandates that we have to sell at the fourth year, but it's more of a business plan. It's looking at what makes most sense from an investment perspective. And for now, it makes most sense that exiting on the fourth year is going to get us a good exit price, and curtailing the risk of exposure. But again, there might be cases where we might want to hold on to it for another year or so, in which case we can totally do that.
Yep. And as you recalled in the slide, having that priority, that 16% compounded hurdle return is compounding. So that's also benefiting too.
Exactly.
Is there a possibility of construction delay with the resurgence of COVID? If so, what are the potential repercussions of my investment?
Sure. So couple things to unwrap there. The Delta variant is a lot in the news these days, and I think in some other parts of the world, it's truly becoming another issue. Even in 2020, Texas had never really closed down on construction due to COVID. Now, in other places like California, that have definitely happened, and that have been a very big, I guess, disruption, for those projects that we had in California. Texas, again, has never really had much of an impact in terms of construction delays due to COVID, because the construction sites have never been really closed down necessarily, due to COVID. Now, having said that, I can't, have a crystal ball and say that the Delta variant or COVID, 21, 22, 23, whatever may come, knock on wood, which will never, but that will not affect the timeline. But again, I can speak, so far as to what we've experienced so far, and it's that COVID hasn't really affected any real construction timelines here in Texas. If there is a delay, then as I mentioned, that first off would be on the general contractor under the GMP. But things like COVID related delays might be attributed to force majeure, or called out from the GMP obligation, and therefore it could incur additional cost to the partners. And as back to the previous question about capital calls, that might prompt a capital call. That might, if it's a substantial amount of additional amount of investment. But again, it's technically it's a 21-month construction phase, and it's also going to be phased. So right now, Stillwater and we are looking at phasing it, because, and I might again share my screen again real quick. The reason why, okay, and I'm gonna go to the map just to.
Oh, you passed it.
Oh, did I?
Yep.
There we are. So as you can see, this 25-acre lot is divided by a creek. here, this is, oh, here, let me do the pointer. This is a creek that divides this 25-acre lot. So you have phase 1 and you have phase 2. And the phase 1 is a 15-month construction. And overall, it's a 21-month construction schedule for now. So the reason why we're talking about phasing it is exactly that. How can you compress the construction timeline so that you're out of the woods and reducing your construction risk as much as you can. And obviously, the faster you get to lease period, the more profit you're going to be making. So that's what we're contemplating. And again, I can't say that there won't be any impact, but again, I laid out that California, different from places like California, Texas, typically gets less affected by COVID, especially at construction job sites. But also, we're trying to mitigate as much as we can the exposure of that construction period by phasing it.
Yeah, and I even can add more, Texas being a more Republican state, California being a more Democratic state, Democratic state having, a little bit more stringent, restrictions and, I guess, stay-at-home orders. Even during the peak of COVID, the first round before Delta, California and many other Democratic states actually exempted residential construction. So they were able to continue construction on residential units due to this exemption because of the dire need of homes and to boost the economy and to continue to supply. So I just want to quickly clarify that. And in addition, speaking to some of the developers during COVID, with some construction shut down, subs, we're also, they still want to work. They're still looking for jobs. So with exemptions for residential, you would potentially see more subs looking for jobs, and this being a residential development, previously being exempt from these restrictions. So I just want to clarify that.
Yep.
Are the construction costs fixed, or can they later change?
So they've been bid out. So I would say we're probably 90% there, but it's subject to change until the GMP is signed, right? And so in that GMP construction contract, we're expecting that to be signed, in the next month or so, month and a half at the most. But the reason why we bid it out today is because we wanted to have a firm number, and this is the number that we're using for all intents and purposes. So there might be small fluctuations, but it will keep to the grand scheme of that $67 million budget.
I spoke with actually earlier this week, and he actually mentioned they were about 95% priced out. The 5% variance costs in which were inflated during COVID, and they're trying to lock that pricing down. That 5% variance is actually trending in the downward direction, therefore potentially reducing the overall budget. As you've seen, if you follow the construction market, wood has dropped substantially, so they've been advised to maybe hold off on purchasing and pricing out, commodities, materials like that, as we continue to see a downward trend. So I just wanted to clarify that too. The 20% IRR per annum, how will the returns be distributed to investors? So is it a 20% IRR?
Right. So the concept of IRR, right? So it is different from an annualized return. So meaning the 20% IRR does not mean that you'll get 20% of your money as return every year. As I mentioned, the first 2 years is not going to have a cash flow. and the return is such that it's skewed toward the back end of this investment, toward the sale event. And therefore, the bulk of your return, and additionally, the hurdles that we mentioned, the 10% preferred return and the 16% preferred return hurdle, are exactly that. It's a preferred return that, you know, in a given year, if it's not met, it gets accrued and shifted toward the, you know, when there is money. And therefore, all likelihood is that your return will be, you know, skewed to the end of the investment. Again, the 20% IRR is an internal rate of return, you know, and by definition, it's a time valued, you know, money for the investment, but it is not, you know, to say that you are going to get a 20% annual return.
Okay. And how will they be distributed?
Well, so for those of us who are in the second deal, you know, which has a current return profile, then, you know, we distribute it out, you know, quarterly on that investment. But on this one, when there's money, you know, that flows into the NHK, you know, Storybook partnership, then it'll get distributed out likely on, you know, at the end of a quarter, or if it's a liquidation at liquidation, you know, time frame.
Okay. We have another question. We wanted to touch a bit more about the supply chain. Have supplies been acquired? What precautions has Stillwater ensured to limit project delays when it comes to material acquisition for construction? I think we might have looked at how they're 95% priced out. The 5% that's remaining, they've been advised by, you know, the professionals to kind of hold off on getting certain materials like wood and whatnot, as those prices are trending downward. So I think those are the protections to put in place. I don't know if you want to clarify a little more.
No, I think we've covered that. Again, you know, once we the biggest hedge for, you know, any fluctuation is if, you know, contractually you're locking them in, and, you know, as Matthew mentioned, you know, we're almost there. And for the 5% or so that have not been, you know, priced out, then, you know, it's trending in the right direction for us, right? So, yeah, I guess. Okay, Matthew, I see maybe a few other additional questions in the chat box.
Yeah, there's a question that came through from Kenny. He wants the 3-tier structure to be kind of detailed a little more further.
Okay, here, apologize. Where are we? Okay, I guess further how? Here, since we're already on
maybe how the negotiations, how the hurdle works.
Okay, let me pull up. Okay, can you see my screen?
Yeah, it's still stuck on the development plan.
Okay, try that again. So, I apologize. Yeah, so again, this is I would say, typical structure when, you know, structuring a deal with a sponsor. So the intent is to you know, make sure that the money partner, in this case NHK, is getting a preferred return that will, satisfy its need, but also at the same time, motivate and incentivize the manager, the developer to, overachieve. And once where it overachieves, share in the gravy, if you will, right? So the way we structured it is that up to receiving a 10% preferred return. So, just using, I guess, numbers as an example, if for your $100,000 investment, let's say for the first year under this scenario, 10% of 100,000 is 10,000. So 10,000 is deemed earned. First year, second year, another 10,000 deemed earned. Third year, another 10,000 deemed earned. On the fourth year, let's say, there is money that is distributable to the partners. And now that distributable amount, however, is, $45,000. Now, under the first hurdle of 10% preferred return that is compounded and accrued, you accumulated, through the 4 years, 40% or $40,000 of deemed earned. And therefore, you get that $40,000, and the remaining 5,000 moves on to the second hurdle. And therefore, under the second hurdle, now you have, a preferred return of 16%. And now, again, same thing. So, 100,000, 16% of 100,000 is, 16,000, right? So that 16,000 also gets accumulated toward the end. And once there's money enough to satisfy that, it moves down to the third hurdle, which is, now it's a 50-50 share between the developer and NHK. So essentially, the culmination of this waterfall structure is the return profile that we represented, right? So this, for your $100,000 you invested into the NHK partnership, going through that hurdle structure, we're targeting that you will get that 174,000 or 1.74x, or, and spoken in IRR terms, 21% IRR over that 4-year term. And again, as I mentioned, if maybe you contact us, separately, then I think we can maybe simulate a return, specific to what you're thinking. Does that help?
I think it does, yeah.
Okay.
Really, the only other question I see is, what is the percentage of risk?
Sorry?
What is the percentage of risk?
Wow, okay. Percentage of risk. Not sure how to answer that. I can't really quantify risk, I don't think. Again, I go back to our FAQ, probably. That's probably the closest that I could get, which is, again, the assumptions, underlying assumptions on this deal, the $2.1 per square foot for the operations, or the 5.75% cap rate for our exit or sale of the asset. I feel they are underwritten in a conservative fashion, and therefore there's room to grow. However, on the other hand, so meaning that the targeted return, we might overachieve the targeted return. On the other hand, the risk profiles are, as a lot of our participants have pointed out, all good questions, right? They're all risk profiles, right? The fact that we're coming out of COVID with supply chain disruptions, as we just talked about. Again, I think we've mitigated most of it, but if if Delta variant becomes a thing, and what will happen. These are all aspects of risk profiles that I ask you to maybe consider, and what your view is. But again, for your decision, Matthew talked about the exemptions, and that different municipalities in different states, have allowed or not allowed, but Texas is prone to allowing it so far. And again, from a risk perspective, I think another participant had asked, what do you think the market is going to be in 2 years' time? Well, I can't say what it will be exactly in 2 years' time, but we have a trend analysis that we've talked about in the presentation, whereby the DFW market again is at the receiving end of a lot of these additions of corporate and population moving into the state, and it's creating a permanent over demand situation or undersupply situation. And we're actually, assisting and adding to the overall, supply. And then we went into the whole SFR concept and so forth. So I think that's probably the I guess the building blocks that I want to present, but I can't necessarily quantify into percentages what the risk of this project. It maybe it might be a little lost in translation. So maybe if you would reach out directly to us, maybe we can readdress that question.
Yeah, I do believe we talked about Sharpe ratio, which measures the unit of risk. If you would like to reach out afterwards, I can definitely walk you through the Sharpe ratio, which I can present to you. Essentially, in summary, the unit of risk exceeded and was substantially more favorable for the property type of apartment and multifamily in comparison to industrial, office, and retail, hospitality. So definitely can reach out to you and clarify on that. There was one more question that came in on the Q&A. It was asking, where is our return coming from for the first few years before construction is completed and the project is operational?
There is no return coming to you. That's as simple as that. So again, during the construction phase,
It looks like Neal's, it sounded like his computer died actually. But yes, during the construction phase, there will be no actual distributions or return. It's all based on an IRR. The returns will commence once it's operational and cash flows are sufficient to be distributed, which is approximately year 3 and year 4. I hope that helps clarify your question. I don't see any more questions in the Q&A. I think we've addressed everything in the chat. So from here, if you have any other questions, you can reach out to your case manager or myself, Neal too. We can assist anything. We can set up personal Zoom calls to walk you through any additional questions you may have. Other than that, we thank you for participating and look forward to potentially partnering with you in the future.